Welcome to our detailed deep dive into the capital asset pricing model, often abbreviated as CAPM. In this video, we'll break down the fundamental concepts of CAPM, illustrate its computations, and explore its applications in real-world scenarios. So, whether you're a finance student, a budding analyst, or just someone curious about how investment risks and returns are calculated, this video is for you. The capital asset pricing model is a framework used in finance to determine the expected return on an investment based on its systematic risk. Systematic risk, also known as market risk, refers to the risk inherent to the entire market. CAPM essentially helps investors understand how risk and return are intertwined in the investment world. The core equation of CAPM is quite simple. It is given by the formula. Let's break down the components of the equation. First, we have E-RE, the expected return on the capital asset. This represents the potential return on investment. Next is RF, the risk-free rate, which is typically the yield on government bonds or treasury bills as they are considered virtually risk-free. Beta-I, measures the sensitivity of the asset's returns to the returns of the market. A beta of 1 indicates that the asset's returns will move with the market. A beta less than 1 means the asset is less volatile than the market, and a beta greater than 1 means it's more volatile. Finally, the market risk premium, ERM-RF, is the difference between the expected market return and the risk-free rate. It represents the additional return expected from holding a risky market portfolio instead of risk-free assets. Now, let's put this into practice with a real-world example. Suppose we have a stock with a beta of 1.2. The risk-free rate is 2%, and the expected market return is 8%. Using the CAPM equation, we can calculate the expected return. First, we calculate the market risk premium, which is 8% to 2% equals 6%. Then, we multiply this by the stock's beta. 1.2 by 6% equals 7.2%. Finally, we add the risk-free rate of 2% to get the expected return. 2% plus 7.2% equals 9.2%. Therefore, the expected return on the stock is 9.2%. To visualize this, let's look at a graph showing the relationship between different betas and expected returns, assuming a risk-free rate of 2% and an expected market return of 8%. As you can see, different beta values result in different expected returns, underlining the importance of beta in the CAPM model. Now, let's address some common questions about CAPM. One frequent question is, what are the limitations of the CAPM model? Despite its widespread use, CAPM has several limitations. First, it assumes that the risk-free rate remains constant, which is not always the case in real-world scenarios. Second, it assumes that markets are efficient, meaning all available information is already factored into asset prices, an ideal situation that isn't always met. Another question often asked is, can we apply CAPM to all types of investments? While CAPM is mainly used for equities, its principles can be extended to other asset classes like bonds and real estate, as long as you can estimate the beta and expected returns. However, the accuracy and relevance of CAPM in these cases may vary. To summarize, CAPM is a vital tool in modern finance, offering a systematic approach to understanding the relationship between risk and return. Remember, the expected return on an investment is influenced by its beta, the risk-free rate, and the market risk premium. And that's a wrap on our detailed exploration of the capital asset pricing model. We hope you found this video both informative and engaging. If you have any more questions, feel free to leave them in the comments below. And don't forget to like, share, and subscribe for more finance tutorials. Thanks for watching.